Okay, hello everyone. I'm Lou Kerner, a fellow crypto enthusiast and a partner at Flight Ventures, where I manage the Israel Founder Syndicate on AngelList, investing in tech companies founded by Israelis. I'm excited to be hosting today's conference call with Yaniv Feldman and the Geek Time team. Today's conference call is on valuing cryptocurrency. And with the market cap of cryptocurrency at over 160 billion, while it's over 160 billion, a number of things need to happen if this market is going to grow past a trillion. And one of those things is the establishment of generally accepted valuation methodologies, so institutional investors can have a framework for valuing crypto investments. And like virtually everything else in the crypto space, we're in the early days of developing crypto valuation methodologies. But given the importance to the crypto ecosystem, we decided to put this call together to help further the valuation dialogue. And I couldn't be more excited about the four cryptocurrency thought leaders joining us today. We're going to start the call with Stephen McKean, an associate professor of finance at the University of Oregon. Stephen will be followed by Chris Berniski of Placeholder Ventures. Then we'll hear from Ryan Selkis, who had a great run as the managing director at CoinDesk. And last but not least, we'll hear from Ari Paul, the chief investment officer at Block Tower Capital. And if you don't already, I encourage everyone on the call to follow these four guys on Medium and Twitter so you can continue to benefit from their crypto wisdom after the call. And when Ari is done speaking, we're going to open the call up for questions from the audience. And you can just type in the questions via the question tab on your kind of go-to webinar tab. And you could start asking questions anytime. And there we have three presentations. Three of the four speakers have presentations, and you can download those presentations if you'd like from the handouts tab on GoToWebinar. And with that, we're going to start the call, and I'd like to turn over the call to our first speaker, Stephen McKean, Associate Professor of Finance at Oregon University. Stephen?
All right, thank you very much, Lou. Is my screen visible now?
Yeah. Yes.
All right, terrific. Thanks for putting this together, Lou. I'm happy to take part in it. I think there's a lot of things to think about on this topic. Let's see here. All right, so what to expect? I am not going to be making a price prediction today. Price predictions are a function of one's beliefs and assumptions. So what I'm going to do is sort of cover how we convert these assumptions to valuation estimates. It's the idea of sort of teaching a person to fish rather than giving them the fish. So we have methods for valuing assets. We're not reinventing the wheel here. But there's some specific differences for crypto assets that present challenges, so I'm going to cover those. And just because we don't have a lot of time today, I'll probably follow up on some of these topics on Medium. So when I teach corporate valuation at Oregon, I usually start from first principles. The concept here is the value of an asset is a function of the future cash flows it will generate. Anyone who's taken classes at business school recognizes this formula, just sort of a discounted cash flow valuation. Now, when we talk about utility tokens, so I'll first cover utility tokens before I get to protocols like Bitcoin and Ether. Utility tokens, now they're not going to generate cash for the most part, but many offer some sort of digital good. So there's lots of examples of this: file storage, identity verification, supply chain traceability, and many others. Now Chris is going to walk through one such example when I'm done, so I'm just trying to give an overview of the framework here. Now, to the extent that we can estimate the value of the digital good in the future, then we can apply this valuation method. The sort of flow of value is analogous to cash flow, particularly if it replaces what would otherwise be a cash expense for the consumer of the good. Now, the numerator is relatively straightforward. That doesn't mean it's easy, but we understand what needs to be done. The denominator is much more difficult. In other words, how do we set discount rates for the value of these digital goods? For corporate securities, we have tools like CAPM, so the capital asset pricing model, but blockchain utility tokens aren't really analogous to equity or debt. The closest thing might be something like a forward contract on a commodity. So for CAPM, we would use beta. Beta is hard to estimate for most of these assets because they just haven't been around long enough to have a lot of data. So when you estimate it for something like Bitcoin or Ether, you can see that it's not stable. It ranges from -1.5 to +1.5 for Bitcoin. If you run a 1-year rolling beta, it's hovered around 0.
Stephen, can you just explain what beta is to the folks on the call who might not know?
Sure. So beta is a measure of systematic risk. So I guess the simple description would be that it's effectively you're trying to figure out how this asset moves relative to the market. So a deeper description would kind of differentiate between systematic risk and idiosyncratic risk, but I think that's beyond the scope of what we have time to go into today. But in a sense, it's the risk that investors care about, I guess is one way to describe it. And I'll follow up this call with, I'm going to write a post on crypto betas on Medium sometime in probably the next month. I think the other issue is that we've got other risks, like regulatory risk. I'm sure some of the other speakers are going to talk about this as well. The question is whether these things are all idiosyncratic and can be diversified away, but regulatory risk is really inherent to the entire asset class. So I think it's more analogous to something like the way we view political risk when we value emerging market securities. The second technique I'll touch on here are comps, or relative valuation. So in this model, you need to identify a value relevant metric, and then the idea is to use that to price the asset. So here's the formula. So you've got a couple assumptions here. One is that you can identify a metric that is value relevant, so that's the denominator here up at the top. The second assumption is that this metric is priced the same across assets. Now, the metric I've seen used in this space recently is on-chain transaction volume. So the idea is, just to be clear, that's differentiated from exchange volume. We're talking about on-chain volume here. The idea is that the volume passing through the network is a proxy for demand for that asset. It's been called the crypto PE ratio. I don't think that term is completely accurate. I was just talking with Chris last night about this. He suggested network value to transaction ratio, which I think is a better descriptor. I'm sure he'll have more to say about that. And then the formula is here, what you see at the bottom of the slide, right, where you're using this ratio for a particular asset, multiplying against a transaction volume for a different asset, and coming up with a valuation estimate. Now, the hard part in this method is that we just don't know yet if on-chain transaction volume is value relevant in the cross section. That would say like between, say, Bitcoin and Ether, or in the time series like Bitcoin 2015 versus Bitcoin 2017. It's just not clear that those transactions should be valued in the same way. So I think a lot more analysis is needed on this. This is something I'm working on with Chris and a friend of mine named Alessio Soretto. It's possible that volume is going to need to be scaled in different ways across different assets. Again, something that I'm sure we'll have more to say on Medium and eventually in academic articles as well. So I don't have a lot of time left, so I just want to touch the last thing I want to touch on is this asset rotation thesis. So you've seen a lot of Bitcoin price predictions that are based on the idea that investable capital will flow from gold into some sort of crypto asset. So the idea is that Bitcoin represents a store of value that's uncorrelated, or at least not perfectly correlated, with other assets in an investor's portfolio, but it has some advantageous properties like low storage costs, low transaction costs, censorship proof, and so on. So the argument then is that there's going to be a rotation of capital. The math is pretty simple in the sense that the supply of Bitcoin is known. So if you were to predict, again, this is not my prediction, but just as an example, if you were to predict that 10% of the aggregate value in gold will rotate to Bitcoin by 2020, and then you look up what's the supply going to be as of 2020, it's going to be about 18 million. You can do the division. So again, if, say, gold were 7 trillion, and you assumed that 700 billion were going to move to Bitcoin, you can do the division and figure out how much value each coin would need to store. So this is a simplified version. There are some complexities like dead coins and so on. And I've seen this same logic applied to, you know, if X% of the foreign exchange market moved to Bitcoin, or X percentage of the global remittances market. People have done similar calculations. So let's talk about what the underlying assumptions are here. I won't call them problems because that's pejorative, but I think that in order to execute this sort of calculation, you've got to make some assumptions. The first is that investors in gold will shift their investment to crypto. Now, it's not clear the degree to which that's happening yet, right? So, you know, as of today, are more of the assets coming from asset rotation, or are they coming from something like evasion of capital controls or some other reason? So the problem is it's very hard to obtain data on this, but it's something I'm going to be working on. The other assumption, this may be the bigger assumption in my mind, is that, you know, if you assume that there is going to be some rotation from gold, when you produce this sort of calculation, you're assuming that it's going to go directly into Bitcoin, and I'm not sure about that. I think you could formulate a thesis that supports that idea, but it's equally possible it could flow to Ether or Zcash, Monero, any other of these store of value assets. So I haven't seen enough discussion about how a rotation from gold might be split amongst different crypto assets, so that's something I think that we need to be talking more about. So I think I'll leave it there and turn it over to the other speakers, and I'm happy to address questions after everyone has presented.
Okay, terrific. Thank you, Stephen. And next, we'll turn it over to Chris Berniski. Chris?
Thanks, Lou. If I could just get control of the screen. Perfect. Okay. Everyone can see the model and can hear me?
Yep.
Yes.
Excellent. So to start, as Steve said, every asset is based on, or the pricing of every asset is based on future expectations, and discounting those future expectations back to the present. Before us, this is a model that I put together around the Filecoin sale and have updated since. And the important thing to realize with this model is this is not, I don't use these models as price targets. And so these models aren't investment advice for you. They're not investment advice for me. They allow me to look at what are the underlying value drivers of a crypto asset. And a crypto asset I see as being composed of two types of value. One is current utility value, which is the value needed by that crypto asset in order to provision that digital good or resource. The other part of value is the discounted expected utility value, which is essentially taking the future utility value and discounting it back to the present. So I'm going to walk through how I do that for Filecoin. Everything that you see on this screen here that's in blue on the left-hand side is an input. And what that input means is it's an assumption that can be tweaked. And so I can change all of these assumptions, and I can make Filecoin worth $1,000, or I can make Filecoin worth 50 cents. And so again, this is to reiterate that this is not a dictation of the truth. This is a tool that I use to try and understand the value drivers of these assets. And so the basic walkthrough that I'm going to go through and the basic framework that I use for all crypto assets is to start out with a total addressable market for that crypto asset. So starting there for Filecoin, right here in C4, I have the total addressable storage demand in 2017, which you can see from this formula is something that I have pulled from some prior work that I've done on the storage market and averaging basically the supply versus the demand of the storage markets. So this is roughly 11 zettabytes. Currently, we're producing about 16 zettabytes of data annually, and it falls within the range of reasonable assumptions, but again, is an assumption. And so over here in row 4, you can see I have annual global storage demand for each year going out. Now, this storage demand should increase as the size of our digital universe increases. And the way in which I do that is with a CAGR, a compound annual growth rate. And what this CAGR does is it grows that total addressable market over time. And so I have created here in C5 a input for how quickly the total addressable market will grow, as well as an input for how the rate of growth will decrease over time. So for example, this ends up decreasing the CAGR over time as a function of law of large numbers. Next, I need to figure out, okay, this is the total storage market, but what percentage of that is applicable to Filecoin? And that's this input in cell C7, which is the percent of the storage market suitable for Filecoin. You'll see this just ends up tracking to the row 6 that just ends up multiplying 75% by the total addressable storage market. So that is the unit side of the total addressable market. Now, on the other side, you need to look at the price, which incorporates a cost decline curve. So my assumption for the price that Filecoin will charge is it'll be roughly half that of the storage network. I have reasons for that assumption, which I don't have time to get into, but again, this is an assumption that you as the user or you as the modeler would need to make. And over here, I have an assumption about the cost decline curve, which I pulled from prior work I've done on hard disk drives and solid state drives. So this cost decline curve, again, ends up feeding into the cost per gigabyte of storage over each year. And so when I multiply together the units by the price, I end up getting the total addressable market here in row 8 in dollars for Filecoin. So that is the dollar amount that Filecoin could possibly facilitate in a year. Now, what I need to do, so that is step 1. That is the total addressable market. Step 2 is then figuring out, okay, what is the percent penetration that I can reasonably assume Filecoin to achieve each year? And the way in which I do this is actually by building an S-curve. And so I'm going to drop down. You can see this table in rows 28 through 31 is now highlighted, and I'm just pulling through an HLOOKUP from that table. So this table, you'll ask, okay, well, how is this S-curve constructed? And it stems from this adoption curve. So there are a few inputs to this adoption curve. The base year, so the starting year, the total saturation percentage, which for this I've made 10%. So that's the maximum percentage that Filecoin would ever achieve. The start of fast growth is the point at which Filecoin will achieve 10% of its maximum. So 10% of 10% would be 1%. And then the takeover time is the sweet spot of the S-curve going from 10% to 90%. So if we look here at this graph, which I've just highlighted, if I change the takeover time to say 20 years, that means the S-curve is going to lengthen out. And so that will obviously have an influence on the price of Filecoin. And so this is where we get into conversations around adoption metrics. If I change it to 5, the S-curve will steepen. So again, yet another assumption. Coming back up to this row 10, basically as a function of my adoption curve, each year I end up having a percent penetration that Filecoin will achieve in its market, which now allows me to get to the next step, which is multiplying the total addressable market in dollars by the percent penetration. I will get what is row 11, which is the dollar turnover facilitated by Filecoin each year. And again, that's just multiplying percent penetration by the TAM. Now, you can't stop there because it actually brings us to one of the most important points of this conversation, which is velocity. Within monetary economics, velocity return refers to the number of times that an asset turns over per year. Over here in cell C10, I have a velocity of 4. Bitcoin has averaged between 4 and 5 as a velocity annually through most of its life. Now, what I want you to look at is if I change the, if you look at row 12, if I change the velocity, if I double it, row 12 should actually get cut in half. Because what ends up happening is the same token can turn over at an increasing rate, which actually means the value that the network needs to store is less in order to provision the same use case. And that trickles down to the price of the token. So if you look at the green row, row 24, if I drop the velocity actually to 4, so the token turns over less, then you'll see the price of the token will actually double. And so this is a conversation that not enough people are having, but if you think of these assets as currencies within private economies, we need to have a more serious conversation around velocity. And as Steve referenced, this is something that we're working on and pulling blockchain level data on to try and analyze. So here I have gotten the dollar stored by Filecoin each year, which can also be called the network value. That is the first step, really, composed of many steps in order to get to the network value. The next process that needs to be gone through is this table, which is really looking at the number of tokens in the float. And so this will get into the inflation rate, the vesting schedule, any number of inputs, which I'm not going to get into in this call, but which will be custom for each asset. The one thing I will point out is this idea of potentially miners having to bond their tokens. What this does is this pulls tokens out of the float. And so what that does is it means there are fewer tokens in the float, which means the price per token has to be greater in order to provision the network value. So the last step here is just taking the network value divided by the number of the tokens in the float gives me the current utility of that token in any given year. Now, that current utility value is not necessarily the market price. So the market price is taken by looking at a future utility value and discounting it back to the present, which is what I have done in this table. So for this table, I can change my end year as an investor when I'm going to exit my investment. So I've chosen 2029. I'm using 2019 as a fictional year. I don't want people to worry about what is my Filecoin worth in 2017. It's not the point of this exercise. So if I look at the value in 2029 and I have to discount that back 10 years at an expected rate of return of 25%, that would mean the market value of Filecoin in 2019 is $4.72. Now again, I can change any of these inputs. If I boost the discount rate, which means it's a riskier asset, the market value will actually be less. And so again, this is somewhere that needs a lot more work. If I decrease the discount rate, the market value will be more. This discount rate shows you the rate of return that you will achieve as an investor. To close, in this table, you can see what I'm doing is any given year I'm looking at what is the market price of an asset composed of. Because going back to where I started from, a certain percent of the market value is going to be supported by current utility value, which I define as means of exchange value, and the other percent will be the remainder, which is the discounted expected utility value, or which I'm referring to as the store value component of this currency. And so for anything that I'm looking at right now, having support of more than 20% current utility value in the market price is above average. A lot of these crypto assets don't even have products out, so they couldn't have a current utility value. And so in closing, this is the current tool that I'm using to assess the value of these assets, and is something that will evolve a lot over time, I'm sure.
Okay, well, that was great, Chris. Really, really interesting stuff. Looking forward to the Q&A to follow up on some things there. Next, I'll turn it over to Ryan Selkis. Ryan?
Hey guys, can you hear me and see my screen?
Yes.
We can hear you fine.
And do we have the screen as well?
I'm not seeing the screen yet.
All right. Show my screen. There we go.
There we go.
All right. We're good now. Okay, so I'll kick off. As my Twitter handle would suggest, this is not investment advice, obviously. I think Chris and Stephen and Ari do a great job of tackling some of the fundamental value questions for this asset class. I wanted to touch on something very, very particular that I think is one of the most important drivers today that people should be aware of, and that's how is money versus non-money valued in the crypto asset space. So for starters, you could probably tell from Chris's analysis, but I think he's probably one of the most forward-thinking about utility value. Strongly recommend folks on this call pick up his book when it comes out in September. There's really three types of crypto assets, and I think he and I might have slightly different interpretations of what each bucket is, but when I think of this, I think of cryptocurrencies, which are primarily intended as investments and long-term store of value. bearer instruments and means of exchange. So this is Bitcoin, Monero, Zcash, Litecoin, etc. There's utility tokens, which Chris went through a detailed analysis of how you would value the utility of something like Filecoin. You can argue that these act like quasi-securities, regardless of what you think, how you think that they should be regulated. But they're needed to use a given DApp and to speculate on the network's long-term value. And then finally, there's crypto securities. I think this is one of the most exciting areas in the industry right now. It's just super early. So these would be tokens which use blockchain tech as enabling technology, but ultimately trade other alternative asset classes with real fundamental value that you might be able to use traditional valuation techniques to get to a conclusion. So. Stephen talked a little bit about asset rotation, which I think is the most relevant tool for cryptocurrencies. Chris talked about utility tokens and how to value them. But at the end of the day, the problem with both of those is just what are your assumptions? And depending on your assumptions, it's going to vary pretty wildly. The biggest problem that I see today is that everything is apparently valued as if it is a currency and has a store of value component that would make it as valuable as some type of money. And I think that's what's led to what a lot of people see as grossly overvalued crypto assets in the long tail of things. So what I typically do when I think about whether there's any fundamental value in a token, I look for how long do you need to actually hold the token to use it for its intended use case. In the case of Bitcoin, you could argue, the killer app is a digital gold. So you want to hold it for a long time. It should be low velocity, and it obviously, fits the description of something that you would want to hold beyond just a, trivially, short length of time to, buy the current and then immediately, have the person on the other end of the transaction just sell that for US dollars or Bitcoin or whatever the reserve currency of the system is. And then the other thing is, how religious really is the user base? How fanatical are people and how certain are they that the currency has long-term store of value potential? And today, I think you could probably only count on one hand the number of currencies that have reached that that level of euphoria and enthusiasm from the user base, and that's probably Bitcoin and Ethereum predominantly, which happen to be the two largest currencies. The reason that I think this is important, people smarter than me, including Naval, have commented that money is the bubble that doesn't pop, right? So I think at the core of the the FAT protocol thesis or AppCoin thesis or money is a bubble thesis is that there can only be a couple of winners for the money use case in cryptocurrency, and ultimately there will be a power law distribution in terms of how that value breaks down over the entire asset class. That brings up another question of okay, if you think that the majority of value in the industry has to do with the appreciation of value in a couple of these key currencies, what does that mean if the market stalls and people start rotating out of tokens that they realize don't need to be held for any length of time to use the distributed applications, and instead rotate into the crypto reserves? So that kind of begs the question, well, if we want to make sure that the currencies that we look for have some money-like attributes, well, what is money? Many, I'm not going to go into the full history of money, we don't have time for that, but generally speaking, good money is scarce, fungible, divisible, recognizable, and portable. And money, cryptocurrencies typically compete on fungibility, recognizability, and scarcity. So fungibility, predominantly being, is it multi-use? And is it truly, censorship resistant? The more censorship resistant, the better. Recognizability would be how much adoption does a given currency have as a unit of account? And a good proxy for that is how many exchanges are supporting it, how many wallets are supporting it, and just generally how liquid is the currency itself. And then finally, scarcity. This is a really important one to think about the monetary supply curves of different projects. not just what the inflation rate is, but for many of these tokens that issue their currencies in one fell swoop during an ICO, what's the corporate treasury policy? How much is held by the project or the foundation backing it? And that ultimately is going to give you a better sense for what the reservation demand of the currency is. I think that Bitcoin, if you look at where its competitors come from a crypto money standpoint, it's really projects that are trying to outflank it on fungibility side, so make it more anonymous, more censorship resistant, and add privacy by default. That's things like Monero and Zcash. Or you're trying to make it a little bit speedier and cost effective to use as a payment rail, so Litecoin, Dash, etc. And then there are other projects that are looking at the, how do you extend the recognizability? And that could be recognizability from central government. So if you want to be charitable, you could say something like Ripple. The potential for it and the upside is, could it be used as an international reserve? Could they get enough banks to buy in because participants in the Ripple network are all known, and it's an easier currency to surveil? Ethereum is an interesting case. I've actually not really thought much of Ether until this year, and I would argue it's not because it's a crypto commodity, but because it's truly become the reserve currency of a distributed investment bank, whose killer app is token issuances and distributed organizations. Up until this year, you didn't really see a need for people to hold Ether in order to transact, because by and large it's relatively inexpensive to run on-chain smart contracts. Now that Ether has become more of a reserve currency for these projects, totally different story. I mentioned a little bit about purpose of holding a token and then the velocity, but just to briefly touch on this, I think you can think about is a currency or is a token truly multi-purpose or single purpose, and ultimately how high is the velocity? You saw from Chris's model that is really a make or break input to any assumptions that you have about the value of the currency. If the velocity is 50 or 100 because people only use a token to use an application for a very short length of time, the value drops by 90%. So you want to see things that are actually going to be held and as Chris pointed out, that have some percentage of the float actually taken out of the money supply. And then finally, you've got two additional issues related to scarcity and then exchange risk, which Stephen touched on. Scarcity, I'd encourage people to look at what the stated inflation rate will be for a given currency, and then what the stated in the event that they're inflation, because this information is not very widely publicly available, and it's certainly not curated anywhere. It's something that I've spoken about with a few other folks and on this call and otherwise, about putting together a repository to make it easier for investors. But you can see what a massive impact that has. With Ripple, XRP is mostly still held by the central issuer, so predictability about whether they burn coins or what the release schedule would be over time is critical, and thinking about the valuation there. Filecoin would, at current prices, need to see an additional $1 billion of net new capital demand, which is 4 times what they've raised in the public sale, just to run in place at $5 per Filecoin based on the first year's inflation prediction. And then Civic, again, as a central issuer, and it has some potential inflation depending on what the Civic team does for their own treasury management. Last but not least is the liquidity issues that you could see with different tokens if there is some kind of exchange crackdown. So we all hope that the regulators are relatively laissez-faire, they only crack down on bad projects. But if they do choose to choke liquidity and stifle some of the exchanges through delistings or trading halts, you could overnight see a precipitous drop in liquidity, which probably affects the long tail of utility tokens more than it does the true money tokens. Those are the things that I would stay up at night worrying about if I was more invested in utility tokens. But I don't think you have some of the same problems as money tokens because they're already by and large trading on regulated exchanges like Coinbase, Gemini, etc. So that is about it. I try to stress with everybody if you're evaluating a project, does the token itself need to exist? And then, as importantly, when you think about velocity, would you hold this for?
I think we lost Ryan there.
When did you guys lose me?
Yeah, just about 15 seconds ago.
When did you lose me?
About 15 seconds ago. You were on the last slide. You were just saying,
okay.
does the token need to exist?
Okay. And then would you hold it for at least a year? Yeah. Yep. That was it. So you lost me at a good time. I was worried for a second that you'd lost me for about 5 minutes.
No. We were good up until the end. Okay. Thanks a lot, Ryan. And now we'll finish up with Ari Paul. Ari?
Hello, everyone. Let me go show my screen here. All right. Hopefully you guys can see everything. Let me hide that. All right. So first, Lou, thanks so much for hosting this this great call, and kudos to everyone on the call for tackling this complex complex new asset class. If an asset class isn't even a great term, everyone on this call, I think, is still we're all still trying to figure out exactly how to conceptualize what mental models to build. So as someone who's been an investor in traditional finance my whole career, it's such an exciting time to be able to be at the birth of kind of this new area of investing and trying to figure it all out. So hopefully, the previous three speakers and myself can be of a little bit of help kind of in your own journey. So my approach in this call, what I hope to add is really a focus on one narrow slice, and that's going to be accessibility. So in traditional finance, we're very used to thinking about a return to beta and a return to illiquidity. We're used to thinking that private equity should earn a return over public equity because you're tying your money up. In cryptocurrency, I think it's useful to extend that concept a little bit. Liquidity definitely still applies, but there's also this idea of accessibility. And accessibility can be limited by many reasons, along many axes. It can be regulatory accessibility, operational, it can be complexity. So we'll dive in a little bit to some different sources. So first, we can look at the literal difficulty of buying a cryptocurrency. So Coinbase is the biggest broker in the US and maybe in the world for cryptocurrency. Sorry, let me try to get that out of there. If someone wants to buy cryptocurrency, if a friend asks me, hey, how can I buy? What's the easiest way? I and most people would probably say, well, create an account on Coinbase, and they make it pretty easy. They charge you a meaningful fee for that service, but they make it pretty easy. Coinbase currently sells 3 cryptocurrencies. When they added Litecoin, LTC is the symbol, when they added that on May 3rd, Litecoin rallied 30% that day. And it actually rallied more than 100% in the few weeks leading into that event. And some people likely knew about that event ahead of time. So we see an effect very repeatedly in cryptocurrency where when it becomes easier to buy a cryptocurrency, that cryptocurrency rallies tremendously. You can think of it a little bit like an index effect. When a stock is added to the S&P 500, it tends to appreciate because they're going to be buyers of it, because there's all these people who are passively buying, the SPY ETF, for example, who suddenly they have an easier way to access this equity. In cryptocurrency, it's extremely pronounced. We see this effect just recently on August 21st, the largest exchange in South Korea called Bithumb, they announced they were adding Monero. Previously, Monero was mostly accessible on US exchanges. If you were in Japan or China or Korea, it was pretty hard to buy. Suddenly, it was added to this large Korean exchange, and that led to a 100% price appreciation over the next 36 hours. And I would argue that's actually, should we call that an inefficiency? It's kind of hard to say because there was a real barrier to entry. If you were, not just for a retail investor, but even if you were a hedge fund manager, if you were in Asia, it was hard to buy. So keeping an eye on kind of on the accessibility of cryptocurrency, I think it makes sense to include that in the pricing. Now, it's hard to quantify this. It's hard to say that, how do I quantify accessibility? How do I use that in a valuation framework? I can only do it on a relative basis. So what I can say is, what percentage of people who I think want to buy this thing are currently able to buy it, and what catalyst may make it more accessible? So with Monero, probably half of the cryptocurrency investing world, almost everyone outside of the US and England really, really had a tough time buying it. So it kind of stood to reason that when it became basically twice as accessible, or as accessible to twice the global population, it would make sense for there to be a very large price appreciation. This doesn't really tell us, this doesn't give us a price target, but what it can do is say very, very roughly, maybe within an order of magnitude, is there currently a major discount to the price that we can buy this thing at? If everyone in the world can easily buy the asset, we can safely say there probably is not a huge accessibility discount. Let's see. Now let's talk about ICOs. So ICOs, initial coin offerings, have exploded in popularity. In dollar amounts, it's gone completely parabolic to the point that they're now actually outpacing angel and seed VC funding. And this is a very new phenomenon. So 6 months ago, ICO fundraising was effectively zero from a capital markets perspective. And suddenly it's gigantic. Why is that? Well, a little bit of it is market psychology. People got rich on the first ICOs. Things like Ethereum did very well. So there's a little bit of this kind of follow past performance. The first ICOs did well, so people want to invest. And similarly, entrepreneurs see it as an easy way to raise money now, whereas 2 years ago, it was not easy to raise money with an ICO. But there's also an accessibility factor in this. If you wanted to do an ICO 2 years ago, you basically needed to create an entire new cryptocurrency from scratch. Today, however, it's fairly easy. It's fairly easy both to create as well as to invest. So Ethereum, which is it's the #2 cryptocurrency, within the Ethereum blockchain, there's a standardized functionality called ERC20 that allows anyone to issue their own cryptocurrency and have it reside, kind of borrow the backbone of the Ethereum network. You don't have to reinvent the wheel. And aside from making it easy to create a new cryptocurrency, it also makes it easier to invest. Once you've invested in one ERC20 token, it's pretty easy to know how to invest in the next. There's also been ongoing integration. So there are websites, for example, like myetherwallet.com, that make it fairly easy to participate in ICOs. Certainly much easier, relatively speaking, than it was a year ago. When I look at this, though, people often say, are we at the top of an ICO bubble? The reality is it's still incredibly hard to invest. So, for example, celebrities have started pitching ICOs. Paris Hilton was just pitching an ICO to her Instagram followers. Floyd Mayweather was pitching one. The reality is that 99.5% of their Instagram followers still cannot functionally, operationally invest in an ICO. It's too difficult. So one thing I'm kind of waiting for to say that this trend is really at its peak is when there's an iPhone app for it. When it's really, really easy to invest in an ICO, when that kind of, when your friend's tween daughter can kind of download an app and just invest in Paris Hilton's ICO, that may represent a peak. But there's still a lot of room for things to become easier. The last area I'll cover is accessibility from the institutional perspective. So there are a lot of obstacles right now. If an endowment or pension wants to invest, or a foundation in cryptocurrency, they may have the technical know-how, but there are a lot of big obstacles. So one is a lack of third-party qualified custodial services. At the moment, cryptocurrency fund managers are self-custodying assets for the most part. And that's a major hurdle. If you're a fiduciary at a pension, for example, it's very hard to check that box and to invest. Another issue are institutional quality investment vehicles. So for example, we don't yet have an ETF, an exchange-traded fund. I think if you had, for example, a index ETF that represented, say, the 10 largest cryptocurrencies, that was intelligently constructed, and maybe where the operational risk was disintermediated and insured by a third party, and maybe that ETF was issued by a bulge bracket bank, I think that ETF would garner well over $100 billion in investment within a year. And that's a staggering statement. That's a very aggressive statement. This entire asset class is currently $164 billion, and I'm saying that I think $100 billion would flow in within 12 months. And what I'm saying is that there's currently this massive accessibility discount in cryptocurrency because of these barriers. And this barrier is a mix of a regulatory barrier as well as a career risk barrier. So there are a lot of investors in pensions and endowments who personally are invested in cryptocurrency, but they're reluctant to invest their institutions funds because their thinking is, well, in my own portfolio, I'm willing to put 1% or 5% of my net worth in an asset that is high expected return, idiosyncratic, low correlation, everything else, and I know it's high risk. I know it could be a zero, or I know there could be, even maybe the asset does well, but maybe there's a hack or a theft or an operational failure. But if you're a pension manager, it's very hard to do that if you're a fiduciary with other people's money. So I think having credible fund managers in the space with track records, having institutional quality vehicles, disintermediation, as well as third-party custodial services will remove a lot of that accessibility discount over the next 3 years. I know we want to leave time for questions, so just to kind of sum up the concept, I think one of the key driving forces of price appreciation over the last 7 years of cryptocurrency's brief history, as well as over the next 3 to 5 years, is going to be accessibility from all angles. Thank you.
Okay, thanks a lot, Ari. That was terrific. Real quick, I'll question of you before we go to the general questions from the audience. The $100 billion figure that you gave, that is a pretty staggering figure. Kind of where did you come up with that number?
So it's not a precisely quantified number. It's talking to endowments and pension managers, foundations, sovereign wealth funds. It is a guesstimate, and it is a bit of an arbitrary number. But for anyone who has the CFA credential, anyone who's taken an MBA class in portfolio theory, here you have an asset class where it's alpha rich for obvious reasons. It's massively inefficient. You have managers who are outperforming even the high data tailwind. And it's idiosyncratic and relatively uncorrelated. So it's something that I can tell you every endowment in the country is seriously looking at it. And the major obstacle right now are these operational hurdles. So if to back into 100 billion, you apply a very, very small percentage. You say if endowments and pensions invested 0.5% globally, you end up with well over that number.
And do you think that that's more from the U.S., international, both?
I think global. This is very much a global phenomenon. So I'm not sure who's going to be first. Endowments will be before U.S. pensions will be among the last, I think, because ERISA and they're just naturally slow moving. Canadian pensions, Scandinavian pensions, and sovereign wealth funds tend to be very forward-looking, tend to move very quickly. So my guess is they'll move faster. On the Asia side, I really don't know.
Okay. Well, thanks. And again, to remind everybody in the audience, there's a question box. We've already got some, but feel free to add some more. I think one of the first questions, Chris, had to do with something you talked about, and that's the velocity question. I think you mentioned that velocity had been 4 to 5, and there was a question for how velocity is determined.
Great. Velocity, there are a few different ways to think of velocity. When you look at building these models, I think the most accurate way to look at velocity would actually be velocity per use case. And so if we think of, even though I have a taxonomy for crypto assets and Ryan also has a taxonomy for crypto assets that goes beyond currencies and includes things like commodities, within their own protocols, their own private economies, these crypto assets do function as currencies. So that's means of exchange, store of value, unit of account. In terms of the means of exchange use cases, this is where the crypto asset is used in exchange for the goods or service of that private economy or that protocol. I think that over time, actually the market will solve for extremely high velocities in those means of exchange use cases. I don't know how high they go. I don't know if we're talking 50, 100, 1,000, but as digitally native assets, the velocity within a year could go extremely high. If that's the case, then to provision that resource, the asset doesn't actually need to store that much value, which is where actually the store of value use case comes in. Store of value, if you hold an asset during the year, that velocity is 1. And so depending on the percentage of the assets that are held as a store of value and pulled out of the float, you can see how the aggregate velocity of the crypto asset is going to be somewhere between 1 and, say, 1,000, or 1 and infinity to make the set even broader. And this just emphasizes the importance of setting up a monetary supply schedule and crypto economics that will incentivize long-term holders.
Okay. Thanks. Does anybody else have anything to add to the velocity discussion? It's obviously an important one. Okay. Let me, another question was a follow-up, Chris, what you talked about. Yes? I'm sorry. Another follow-up was when I think you mentioned that when you decrease the take over time, and let me just read this question exactly. When you decrease the take over time / adoption, why does current utility value go down?
If you decrease the adoption over time, current utility, I mean, it's a bit of a weird question, but if the adoption of the crypto asset is decreasing, then actually its percentage of the target market, that share will decrease, and thus the value that it is facilitating, the value transfer that it's facilitating will also decrease. I'm not sure if that was the intended question, though.
Yeah, I think that was pretty straightforward. And as you think about valuing, and this is obviously, I think probably all the speakers have kind of pretty deep experience in terms of valuing equities, traditional assets. And Chris, when you went through your analysis, it seemed like the first half, up until you got to kind of turnover, which I think is revenue. Up until then, you got to, it was pretty similar, and then obviously it started to then get into this whole new world, that's only relevant to crypto, and talking about, things like velocity. When you're sitting and talking with potential investors, what are the things that they're really focused on when you're trying to help them explain? And this is for everybody, the things that kind of investors, traditional investors, or just crypto investors are focusing on and trying to get their hands around. And Ari, you want to start on that one?
Sure. It's really challenging. I think a lot of the investment world is kind of, as this call reflects, is really just trying to get the basic mental frameworks. And we are at such a nascent style. Ryan recommended Chris's book. I'd recommended it as well, just to kind of get that basic framework. One angle I can comment on very directly is for institutional managers. A key question is literally, where does this fit into the portfolio? Is it absolute return? Is it venture capital? Is it and the way, what I kind of say about it is useful in this sense to think of it as an asset class, just as there's a lot of ways to profit from equities and a lot of ways to think about alpha or general return in equities, right? So you can think about equities as an illiquidity premium from a venture capital approach. You can think of it as a operational premium from a leveraged PE approach. You can think of it as just kind of the beta, the risk you're taking. Maybe there's a risk premium, a small cap or value premia in the market. And you can also think of it from a active trading, absolute return, merger arb, event-driven approach. So I think it's still kind of very early days, and people are really feeling out even the most basic questions.
Yeah, go ahead.
No, I was just seeing if Stephen or Ryan wanted to add anything to that.
I guess I would echo what Ari said, which is that most institutional investors don't own crypto yet. I'm part of a chat group called BTC Nation. We often talk about going out and speaking to institutional investors, whether in VC, hedge funds, and so on. The fact is that most people we talk to really are just trying to get the basics. They're just trying to understand it. They're trying to understand the security and how, definitely a lot of them are concerned about, the hacks basically get a lot of publicity, right? So the news articles about exchanges where private keys get stolen and so on seems to dominate the thinking. And so I think the rise of custodial services, again, it's, as Ari mentioned on and others, is going to be important, because if you have fiduciary responsibility, you have to take security of the assets very seriously.
Okay, so we've been getting more than a couple of questions about regulation, what's been going on in the US and China, South Korea in the last couple of months. How do you guys think, regulation will go into effect into what we were talking about? One, evaluating the currencies themselves, and later on what Ari discussed at the end, the entrance of institutional investors into the market.
The main thing is I think it adds an uncertainty overhang. So I've been thinking about this from a investment perspective, and kind of a conclusion I've come to, and this is speculative, is that almost any announcement from the SEC will be bullish most of the market, and we've seen this repeatedly, by the way. This is kind of a common psychology thing, that the fear of uncertainty is often worse than almost the worst case outcome. So at the moment, the cryptocurrency investors, whether it's institutional or even people like myself who are knee deep in the market, there's a concern. What's the SEC going to announce? What's China going to announce? And what we've seen repeatedly in the cryptocurrency market is kind of the worst thing happens. So back in, I think it was March, China basically froze all cryptocurrency trading. 3 days later, we were at new all-time highs. So the SEC, my best guess is that in roughly 1 to 3 months, they're going to announce criminal proceedings against probably 1 or 2 or 3 ICO projects that are outright scams. And I think it may cause a momentary concern, a momentary freeze, a brief sell-off, and then it's almost immediately going to be bullish, because everyone who isn't doing an outright scam is going to say, okay, we see who they're targeting, we see who the SEC is really going after, and it's a little bit of a safety valve that kind of gets released, where you have this pent-up concern and uncertainty. I think the main effect it has is not on the projects themselves, or from my perspective, I'm very confident that everything we're investing in is well on the right side of any regulatory issues. But for an institutional investor, a pension, for example, it's just another uncertainty. It's another thing they feel they have to become an expert in, they have to get comfortable in. It's another box they have to check that definitely slows down the process of investing.
The other thing I would add to this is, if we look at what happened with China in late 2013 and early 2014, when they came out and said Bitcoin wasn't a real currency with real meaning, but then how, when we look at early 2017, they backtracked a little, right? And they actually put in regulation that I've interpreted as helpful to the adoption of cryptocurrencies more broadly. And so just because a regulator takes one action now doesn't mean that will last forever into perpetuity. And I think that something we'll see happening a lot is this idea of regulatory arbitrage. So I think everyone understands this is a massive innovation, and if you push that innovation out over the long term, a nation-state's economy may suffer, and that will put pressure on the regulators. So we're going to see shifting around of these teams to the most favorable regulatory regimes, which then could incur counter-regulatory actions from some of the more unfriendly nations.
Okay. So we have a question about, do you guys believe in a broader adoption of blockchain technologies in the IoT space that will create a secondary positive lift in cryptocurrencies? Is that something that you anticipate?
I think that anything that's an information network can be tokenized and someday will be tokenized. Steve has written a great post that, Steve, you may want to talk about in terms of tokenizing traditional assets. But really, we have a broad-based mechanism with blockchain technology to securitize and distribute value at near zero cost. And the ramifications of that are still yet to be seen.
So I'll just comment real quickly on the post that Chris mentioned. I know we're almost out of time, but there is an argument that we've got a bunch of traditional assets. So examples would be real estate or venture capital, where investors get locked up for a long period of time, or it's difficult, or I guess really the right word is costly, to trade. And to the extent that some of these get tokenized and start trading, and to be clear, these are securities, right? So they're definitely going to be subject to regulatory scrutiny. But it could open up liquidity, and there is, a liquidity premium is one of the factors that comes into play when we think about value in assets. So I'll leave it there. The post is up. I'm sure it's something I'll be writing more about in the future as well.
Okay, Lou, do you want to sum up, or we have time for one more question?
Yeah, why don't we do one more question?
Okay, so there are a few questions here talking about ICOs, startups raising money through ICOs against the traditional venture capital model. We're definitely seeing a rise here. We're seeing more than a few startups that aren't even have anything to do technology-wise to the blockchain, trying to raise money through ICOs. What do you think will go on, and how do you value these kind of companies and their tokens?
I think the most important thing that people need to look at, or one of the most important things with ICOs, is what are the incentives? Why is the team doing this? Especially if it's a pivot from an existing company that is looking to ICO. Is it a means to bootstrap capital and support an unsustainable cap table? If that's the case, it's likely going to be a dead end. If it's truly creating an asset to incentivize a distributed set of actors to provision a digital good or resource, then that's a crypto asset to me. If it's not, then it's a likely bastardization of what this technology is meant to do.
Do you see any kind of combination between, the value of the company raising money from VCs to the value of their tokens?
I mean, again, that's where you're using capital raised from an ICO to support the cap table, not actually to incentivize a distributed network of actors, and in that case, you should probably go to the VC markets. So I think we're going to see a period of transition here, a lot of experimentation. Some of it works, some may not work, but if intentions are not right within these open systems, then I do think that open system will ultimately fail. I think Ari wanted to say something, though. I saw him unmuting.
I'll add just I guess a slight point of disagreement is even too strong. I really agree with everything Chris said, but a slight nuance. I don't have a problem with so cryptocurrency and blockchain were born together. Bitcoin was the first cryptocurrency. It was also the first blockchain. It's actually a point of confusion. It's almost unfortunate that the same word was used. Bitcoin with a capital B is the network. Bitcoin with a little b is the coin, is the cryptocurrency. In Ethereum, you have the Ethereum network and you have Ether, the token, which is a little bit clearer. So what Chris is saying, or I don't mean to take words out of your mouth, but generally most of the value comes from keeping those two together. That's kind of the revolution. However, I don't have a problem with separating the two. There are a lot of blockchains that don't need a cryptocurrency that are basically just better databases. It's an incremental improvement. And similarly, cryptocurrency as a fundraising method, I think, is totally valid and reasonable. The problem is it just can't be valued as a revolutionary technology. It's not. So if your local, if someone wants to create, let's say, a dry cleaners and they want to raise money for friends and family and they want to tokenize it to provide liquidity, there's nothing wrong with that. We just need to recognize that shouldn't be a $100 million fundraise, right? Because it's for a traditional business that needs to be valued traditionally. And so what's happening right now is some traditional companies are trying to raise business for traditional projects, but they're receiving blockchain or cryptocurrency-like valuations, which is a problem because those investors are going to lose their money.
Yeah, it sounds a little reminiscent of the dot-com bubble.
Yeah.
In any case, again, gentlemen, Chris, Ryan, Ari, Stephen, you are all terrific. And thanks for everybody for attending. We're going to be having a SoundCloud of the call available, so you can share it with friends or anyone you think should hear. And again, I want to thank everybody, our speakers. I thought they were all terrific. Thanks, guys.
Thanks a lot, Lou.
Thanks, Lou.
Thank you.
Thank you, everyone. Good night.